Hello, everyone, and thank you for joining us this evening. We're really delighted to be working with Investec on this series of Investor Academy sessions. This is our fourth one with them. As well as an economic update, we'll focus on the technology, media and telecoms sector today. Very timely given the political and geopolitical drama we're currently facing, as well as the movements in the TMT sector. Very quickly, I'm Sarah Turner, co-founder of Angel Academy. We're a network of angel investors. We invest in female-founded startups and introduce more women to angel investing. We've backed 44 promising startup businesses so far, all but one in tech or science. Most of them fall into the TMT sector, in fact. When we started way back in 2014, there were only a tiny number of women investing, and the networks that I was part of really didn't deliver what I needed or what I thought female investors would need. So Angel Academy was created with women in mind to help close the gender investor gap, as well as the low levels of investment going to female founders. Our value proposition for both investors and entrepreneurs is our depth of experience. We've reviewed literally thousands of pitch decks and met thousands of founders. We're well organized and transparent. Our members are successful entrepreneurs themselves and senior leaders. Men are very welcome too and make up 30% of our membership. And finally, we're proud to be ranked as one of Beauhurst's most active angel networks in the UK, and we're the only female-focused network to appear in that ranking. So enough about us. Without further ado, I'd like to introduce you to our panel. There are two short presentations followed by Q&A. So I've got a few questions to kick things off, but please put your own questions for the panel in chat. First up is Sandra Horsfield with her regular economic update. Over to you, Sandra.
Hello, and thank you very much for inviting me to speak again. I wanted to run you through briefly of how we currently see the economic outlook at Investec. The key focus, of course, at the moment everywhere is high inflation, and that is our main focus and the main focus for policymakers and markets alike as well. Where do we stand on this? Well, first of all, we have to understand what has brought us here. Why is inflation so high? Some of those of you who may have listened to a previous talk may recognize this slide. What I tried to summarize is the idea that some of the current inflation comes from different sources. We have supply constraints. We're all very familiar for those. Those were a major driver of inflation early on in the COVID period. And of course, we know that COVID restrictions have now largely eased, but they are still present, and certainly they are still present in China. So those supply disruptions that relate to China are still with us. And the components of inflation, this is UK inflation, but you could draw similar pictures elsewhere, that are affected by supply constraints have still shown a fairly high rising trend. The other part that has come about more recently is, of course, post-COVID unlocking of the economy. So sectors that were previously unavailable have seen strong surges in demand. Hospitality is part of this, travel is another part, and these sorts of components where there's a strong demand surge after unlocking have also seen a very big move up in their contribution that they make to overall inflation, and the sort of gray bars that we have here. On top of that, of course, we have the commodity shock that has come about. It is worth remembering that actually in the midst of the COVID recession, we had a temporary period where Brent oil prices were actually negative. We had a decline and in fact a negative contribution from energy prices to headline inflation. That's very different from the situation we're facing now, where of course energy prices have risen very sharply. It's not just oil, it's gas as well, but it's also a whole host of other raw materials that are also affected by the war in Ukraine and have been amplified as a result. So all of these factors are still present, and there's increasing signs that the wider price pressures are also broadening. So the sort of green bars here are other components that don't naturally fall into these categories, and those too have seen an increase in contribution. So it is not only historically extremely high inflation, but also broader and wider inflation that we are experiencing. If we take a step back from these sort of special factors, we have to put this into the context of where we are in the labor market. Typically, we tend to think that labor costs make up about 60% or thereabouts of a company's cost base. And in the current situation of high inflation, the key question is really, will these high inflation rates translate into high wages on a sustained basis? High wage growth then feeds further into costs, and will we get a wage price spiral? Well, the good news and the bad news is that we are in a very tight labor market. It is, of course, good news for many of those who are in employment who hadn't been in the past, but in a way, we are victims of our own success. What I mean by that is we are entering this period of high inflation shocks with very little slack in the labor market. The lines that are drawn here show how the UK unemployment rate has performed typically in various downturns. And so the dates are the start of the downturn, the peak of the cycle. In all but one of the previous downturns that we've seen, unemployment has risen. That is not a surprise to anyone. That is a typical feature of a recession, and that's what you tend to get. The one exception being the ERM crisis, that's the golden orange line, in which it turned previously very sharply. The current experience is the very bottom line. It's the October 2019 line. So not only, yes, we did get an initial rise with the unemployment rate in the COVID downturn, but then substantial falls, which have brought us back to where we were before the crisis started, and indeed to a historically very low level. So we are at a level of very low unemployment entering this, which makes the situation in a way more dangerous. Not only that, but we also have vacancies which are at a record high. Indeed, the numbers aren't very easily comparable. Perhaps the history doesn't go back that far, but as they appear, the unemployment level matches the level of vacancies pretty much exactly on the official numbers. So there are as many vacancies out there as people who are unemployed. That is an extremely tight labor market. The thing to bear in mind is what happens in future downturns, and that's perhaps more of a concern of mine. We're seeing it a little bit already, because we have been so very successful in containing unemployment and keeping it from rising. That has, of course, come at a huge fiscal cost. And the pressure to offer similar support in future downturns is very much with us. What else is adding to inflation? Well, one of the factors that we're experiencing in the UK here is a falling pound. And that is something that also adds to inflationary pressure, because, of course, we import part of the goods that form part of our expenditure basket. The inputs that come into this, and those inputs are getting relatively more expensive. What has driven the pound lower? Well, part of it is really not so much a sterling story, but more for a US dollar story. In the US, interest rate differentials relative to other countries have risen substantially. Expectations have been met by the Fed that they're particularly aggressive in dealing with the inflationary pressures that they're experiencing. That has driven the dollar up, and conversely, as counterpart to that, sterling and other currencies down. Of course, more recently in the UK, there's some signs that the politics hasn't helped very much either. There have been discussions around what to do about the Northern Ireland Protocol, which has raised some concerns, perhaps in markets again, about uncertainty where the trade relation with the EU might be going. There's also speculation, indeed, Nicola Sturgeon has called for the Scottish independence referendum, the second one, to take place on the 9th of October 2023. Now, the government hasn't granted this, but all of these uncertainties about trading relationships are not helping. Whatever the cause of the weakness of sterling, though, it's clear that this will only add to inflationary pressure as we're seeing it. How do we get this back under control, and how is this being responded to? I already alluded to, and this interest rate rises are really going to be necessary to bring the situation in check. What's important to note is that, of course, central banks are unable to get more gas to Europe. They're unable to get more commodities to the places where they're required, etc. What they can do is affect the labor market. And a lot of this is about creating some of the slack that was not there beforehand through interest rate rises. Naturally, interest rate rises by themselves will cause some cooling in demand and squeeze margins that companies are experiencing. And that in itself will help to cool inflation further down. Also, when it comes to supply chain issues, over time, one would expect that the situation gets resolved one or another, where there are particularly large pinch points. Of course, that provides an incentive to enter markets for companies and to alleviate these pressures. So over time, these issues should resolve. The big question, though, is to what extent we're moving less back to where we were beforehand, which was more the just-in-time supply chain, but more of a just-in-case supply chain, in which case perhaps we talk more about onshoring, reshoring, etc., which is frankly more expensive than the alternative. Otherwise, we would have chosen it in the first place. So perhaps we're not quite looking at going back to the sort of previous pattern of trade and supply chains that we had beforehand. Finally, though, we have to bear in mind that commodity markets, even though they're still very much under pressure at the moment, seem unlikely to repeat the sort of inflationary increases that we've had beforehand. Inflation, remember, is the change in prices, not just the level in prices. So we would need to see, as we're seeing now, 40%, 50% increases on an annual basis continuously if we wanted the same upward pressure from energy prices. That seems unlikely. Our team of energy and utility analysts here reckons that, yes, we're in for a period of sustained higher prices, but not necessarily a period of further rises in prices. So that will put some downward pressure on inflation as well as we go through time. What does this mean for the growth outlook? Well, we have become somewhat more cautious, especially in light of the very steep rate of interest rate rises that is coming to some extent, and that has taken place already. We think that the brakes will be pressed sufficiently hard by policymakers to maintain their credibility, to see margin squeezes, and also to, as I said, bring up unemployment on purpose. All of that is a negative, and we think that the UK and the US in particular look poised for a recession. The good news is that we have some buffers to deal with this situation. Certainly households have amassed a lot of savings in the pandemic that they can dip into to perhaps cushion some of the spending effect in aggregate, even though not necessarily for every household. Certainly lower income households are particularly hard hit. Equally, from the company's perspective, it's important to remember that the energy transition, which is of course accelerated in the aftermath of the Ukraine war, will be accelerated, and that will require investment, and that investment adds to GDP growth as well. So we're not looking at anything like the deep recessions that we had in the global financial crisis, or certainly during the COVID period, but a shallow dip. The reason why we hadn't penciled in a recession in the Eurozone is that there the need for this transition investment is particularly strong. It relies, however, on the assumption that we don't get the shutdown of Russian gas supplies to Europe. That is certainly a risk. final good news, we're not seeing a financial crisis coming about. Banks have strengthened their balance sheets a lot through regulation in the aftermath of various crises that we had. And without having a financial crisis, typically recessions tend to be less long-lasting and less deep. So with some luck, that is the experience that we will have this time around as well.
So the good news is no financial crisis. Thank you, Sandra. That was a really good kickoff. I'd now like to invite Pippa and Seb to the stage. They're from the TMT M&A team, and they're going to give their view of what's happening in that sector, more focused on the private markets.
Hi, yes, thank you so much for inviting us here today. So my name is Pippa Harries, and I sit in the TMT team here at Investec, advising both public and private companies on their M&A strategy. And then we've also got Seb Lawrence here, who heads up the team. I'll just let him provide a quick introduction as well.
Seb Lawrence, been bank for 10, 11 years. We've very much focused on sort of technology, media, and telecoms, sort of across M&A and the public markets.
So off the back of everything that Sandra's been saying, which is very helpful and interesting on the economic point of view, we just thought we'd dive in a bit into the tech sector and what we've been seeing happening both on the public and private side. So back end of last year, if you just look at the graph on the top left, we noticed that share prices had absolutely flown up. And this year we've seen a big correction following the war, inflation concerns, and concerns about recession. So on average, prices are down about 20%. You've got some sectors, some tech subsectors being hit harder than others. But on the whole, there's been a big contraction in prices, and then also in their valuations and in their multiples, which you can see on the bottom left-hand side. What we've noticed on the tech side of things is that there's been a big shift in public investor mindset, going from the high growth companies, which is typically what we deal with in tech, to more quality assets that are profitable and making cash and going down to the bottom line. Seb, I don't know if you've got anything else to add on this one as well.
Yeah, look, I think it's quite interesting because it plays into a lot of what Sandra's spoken about from sort of the macro point. But if you look at some of those charts on the left-hand side, the subsectors within technology, particularly software, particularly the sort of consulting people type businesses, where valuations were very high. Those businesses, the consulting side, traditionally valued on EBITDA multiples, are now being valued on revenue multiples, and that's come off a fair bit. And then on the software side, and very relevant for a number of people here when you're thinking about investments that you're making into high growth technology, people very much looking and favouring a shift away from loss making to profitable. Can we actually make sure that we can see near-term cash profitability? And that's driven valuations downwards and have come under pressure, but actually have started to normalise and started to hold in the last few months as people are feeling like we're actually into a level of normalisation now. We'll explore that a little bit over the next couple of slides.
Yeah, and I think just on Seb's point, we noticed that obviously when the prices went up really significantly back end of last year, although they've come down, what seems like a lot in the past 6 months, it's actually at a more normalised level, and we're kind of going through that cycle again. This takes us on to our next slide, which talks a bit more about the differential between the public and private valuations since following this sell-off. So as you can see on the top left-hand side, across many of the subsectors that we deal with, so software, consulting, IT managed services, and then also the telco side of things, they've all got a quite a big delta in between the public and the private transactions. We've also noticed that between the UK and the US, there's also a very big difference between the valuations on that side of things. So while historically the valuation difference is about 60% between US and UK software businesses, that has closed slightly, but there's still a really big differential in between these two sectors. We've also noticed that in terms of buyers, there's been a lot of activity from the US coming over to the UK and looking at UK assets that trade at a discount to the US, but still offer the same kind of specialist, really high quality technology. So as you can see on the right hand side, you can see that in the UK P2P, so in the take private transactions, the majority are actually pushed forward by US companies, be it trade buyers or private equity, due to that big valuation gap, despite the similar level of high technical capability.
And I guess, you know, sort of the next question that we tend to get is, so if you're seeing those as kind of market trends and that's happening in valuation, what's happening to activity levels across the market? So this is looking sort of, you know, broadly across the European M&A market. The UK has for some time and will remain, you know, probably the most active market where the majority of investments are being made in Europe. But actually we are still seeing pretty high levels of activity, you know, across the sectors. You're seeing a lot of these transactions are happening, you know, into various different markets. So you can see UK kind of double the size of the nearest one, but Germany, France, Nordics, and Netherlands kind of being the sort of major areas of tech hubs, and also having a really strong VC scene, and that's driving a lot of activity. And actually, you see that as being, you know, partly what is underpinning the sort of levels of growth. So, you know, UK market traditionally has had a very strong financial backing for startups, you know, partly driven by the tax advantages over here, and that's driven a lot of volume. But others across Europe seeing similar as well.
Yeah, and I think we've also noticed that there's been a significant number of kind of cross-border transactions, particularly throughout COVID. That level just absolutely flew up, and even going into this year, despite lower levels of activity, there's still a lot happening across the whole of Europe and acting as kind of one hub rather than just exclusively in distinct countries.
And then actually, this is quite interesting because if I just kind of draw your eyes to the chart on the bottom right hand side first. So where is most of the kind of investment, where's most of the money been coming from for these sorts of acquisitions? Well, certainly the last 4 years, most of the investments have come from financial buyers, so, you know, typically private equity, but also venture capital funds as well. Strategic buyers, who are your typical trade buyers, have then made up the rest. So some are listed companies, private companies, some are private equity backed. If you look in the last 7 months, so 2022 to date, actually that trend has really shifted. So a lot of these strategic buyers who are backed by private equity have been very aggressive, and that's basically private equity using the capital that they have on their balance sheets, the money that they've raised as their funds, and saying, okay, well, we want to invest that pretty strongly into the market. They're doing less platform deals, so less kind of investments in their own fund, but still backing a buy and build story, and that's really important because actually that shifted away from where, you know, typically the financial buyers have been playing, and it's partly a risk perspective actually. You know, it's easier for a business that you already know that you're already back to go and do an acquisition. It's a bit more risky if you're doing that as a platform investment, where you've got to try and work out, you know, if I pay a price today, what will that mean in 3 to 5 years' time? If I've already got an asset, I can already take a bit of a view on that. And then the other thing that we kind of notice, and this is a little bit on the left hand side, is actually there's a pretty significant number of those investors and of those strategic acquirers for businesses. So, you know, lots of high growth investors like a TA, like an HG Capital, as well as a number of big market consolidators. So IDOX have done a lot into the public sector. Software over the years, they're a listed business. Trax is similarly as well. So we are seeing the activity levels changing, very much still, you know, weighted towards private equity and financial sponsors, but increasingly through their strategic platforms that they have. So when you're thinking about, okay, what does that mean for the investments I'm making and and who are the likely buyers of those businesses, that's probably flipped a bit more away from sort of follow-on equity and probably a bit more towards trade investors as a result. And what that's meaning is actually we're seeing more and more of these sort of so-called buy and build stories. The names that you see on this slide have got private equity backers, and they have been highly acquisitive. So Vance on the top right, buying lots of different types of businesses, from legal technology with Ticket all the way through to healthcare technology, and they're becoming mini conglomerates. This is a new thing in the market, is that actually businesses get bigger and bigger and bigger, and the private equity houses wanting to continue to invest behind them. So the typical sort of 3-5 year investment horizon that they would normally have, actually they're saying, look, these are really good assets, difficult for us to find other assets of a similar quality, so we're going to stay with them and we're going to continue to invest. And the way that we'll invest is those businesses going and doing more and more acquisitions. And you see that with, say, the likes of advanced businesses like Harries as well, where the private equity houses are saying, look, we basically want to double down in the sector. And so we see these sorts of names being more and more active amongst the, amongst kind of the VC market as being acquirers of a large number of businesses, particularly when things like the public markets are closed at the moment for IPOs as an exit. You can guesstimate when that may or may not come back. I think most people are of the view that that's probably not going to happen this year. Hopefully January, February time it starts to reopen next year. And therefore, for businesses that are looking for exits, or potentially where actually they weren't able to raise as much money because the venture capital markets are a bit tougher, these are the sorts of investors and acquirers who are very strong at the moment. Sandra, we'll pass back to you.
Thank you very much. That was a really great overview. Sandra, would you like to join us back on screen? So anyone in the audience, if you have questions for us, please post them into chat, but I've got a few ready to go. So firstly, Sandra, when can we expect inflation to get back to target?
That's the $1 million question. Probably actually more than $1 million by now. I think in terms of the UK, given the sort of profile, which of course you need to make some assumptions about what happens with energy prices, and the standard one which we have followed is to look at market prices for that. We've built in inflation expectations, we've built in expectations of what the labor market will do, etc. We think it will take until towards the end of next year when we'll get back to sort of target inflation in the UK. That's a long time, and certainly we're looking at rates, perhaps a peak of at least 11%, perhaps 12 or so come this October. This is a very unpleasant inflation environment that is here to stay for some time, and that will require most likely some further government help, especially for those who are least able to bear it.
Okay, and I can't fail to mention it, but we've got a change in Prime Minister coming up in the UK. What difference does that make to the UK outlook?
I think from the perspective of pure economic policy, where the candidates seem to be differentiating themselves is perhaps on the taxation side. So other than Rishi Sunak, who seems to be arguing for maintaining the previous stance, a lot of tax cuts are being put on the table, affecting various sectors, sometimes more households, sometimes businesses, etc. Obviously, it depends who actually would replace him if it were not Mr. Sunak. If we were to end up with more tax cuts as a means of doing so, that would be something that the Bank of England would probably treat as excessively stimulatory and requiring further interest rate rises to deal with the situation. So there is the interaction between the Prime Minister and what happens on inflation and interest rates.
Okay, thank you. So Seb and Pippa, you mentioned that it's a tougher VC market. Can you give a little bit more detail of what you're seeing in terms of companies trying to raise funds, or indeed VCs trying to raise funds?
Yeah, so maybe if I go first and Pippa jump in. So the VC market is really tough, and it comes down to that shift in in the inflationary environment in reality. So people chasing near-term cash rather than trying to invest behind high growth, typically loss-making businesses. So what we've seen is that actually there's a drive, and you see it for some of the big names. So Klarna has been in the news recently about having big down rounds. So you're seeing the valuation bubble being very challenging. So people having to raise money at lower prices as a result, or lower valuations as a result. And then the VC funds themselves, because you were able to write investments up for many, many years, they haven't returned as much cash to invest to their investors over the years as people would have expected. And so they're now under a lot more pressure to return capital back to their investors. And it means that raising new funds is more challenging. And so actually we're seeing a bigger and bigger gap for high growth businesses, because actually there's not as much liquidity in the VC market right now.
Okay, it's really interesting. I just, I suppose my view of this is that it's an overdue correction rather than any sort of crash, and that, we've been doing it for a while. We've been expecting something, and certainly kind of pressure on inflation and interest rates. People have been forecasting for a long time, even before the Ukrainian situation. Is that your view? Are things going to? Is it an overdue correction, or is it worse than that?
Yeah, look, I very much agree with you. This is an overdue correction. Tech has been on an upward trajectory for probably the best part of a decade, if not longer. And so actually valuations have been at peak levels. And so at some point you see people take a breath, and this is probably that breath. I think the question, and there's probably an open question, is this the new norm? Is that sort of 20% correction that we've seen? Is that the new normal level, or is there more to go? Technology is very different now. Technology is today's modern infrastructure. You can't run your business without it, and so we do think that things will continue to grow and valuation will continue to grow, but this is the market taking a breath because of the inflationary factors that that Sandra spoke about.
Yeah, and I think there was a particular kind of increase in valuations during the last couple of years during the pandemic. I know certainly there are certain technologies that helped us keep our business going. So I think everyone got a bit carried away. So we're grateful for the correction in valuation. Just a question about Brexit. So have you seen a change in the balance of M&A activity between the UK and the continent since Brexit?
Actually, no, we haven't. There was obviously a lot of fears about what might or might not happen as a result. The UK market in Europe is quite an interesting one. We're probably more closely aligned to US buyers and US investors in the UK maybe than we are more European side. What we've actually seen are a lot of the UK businesses saying, right, actually Europe is a very good landing post for us. US is big and exciting, but we need to go and do that, and therefore Europe's quite a nice place. And so what we've actually seen are particular areas within Europe that people are particularly kind of landing into the Netherlands has been a big area. Nordics another, and so we have a lot of our corporate clients who are sat there saying we want to go and acquire into those regions, and sort of beer drinking has been sort of flavour of the month more so than maybe the wine regions at the moment, but we do see that changing. US though, and it goes back to the valuation point, that sort of remains the holy grail for most people in tech at the moment.
Yeah, I just build on Seb's point, just as a data point, for the past 5 years, over 40-50% of the transactions have all been kind of European cross-border in the tech software space anyway. So, and it doesn't show any sign of it slowing down. It's fairly flat kind of, in the past 4 or 5 years.
That's good to hear. And why is there such a big gap between UK and US valuations? And is that going to remain the case?
It's something that Seb and I speak about quite frequently, because I understand why we have these really, really amazing, successful tech companies in the UK with very similar product offerings to what we have in the US as well. But we think it's a lot of the investors in the US are very specialist and very sector and subsector specific and very knowledgeable in that area, whereas in the UK, a lot of the funds are deploying on a generalist basis. They don't necessarily have that tech focus, and we think that's probably what's driving the differential, is that you've got all these investors in the US who know the sectors really, really well, and they know the value of these assets and just place a much higher premium on them. And then equally, it's just a demand thing as well. There's just like really significant demand coming over for the US assets as well. And that's probably our kind of key view, but there might be some other sort of factors.
Yes, we spend quite a lot of time managing expectation with entrepreneurs that they won't see US type valuations in this market, but yeah, interesting. So you mentioned something about the emergence of PE conglomerates. What are the implications for early stage investors like us, or entrepreneurs who are still in the early stage of building their business? How does that change the dynamic for us?
I mean, it provides a good when it comes to exit, it's quite a good opportunity there in terms of there are lots of, you've got these very well capitalized businesses that have the existing infrastructure that can invest in these earlier stage companies. And I think particularly, what Seb was talking to earlier, in terms of we aren't seeing as many kind of platform acquisitions, we're seeing more bolt-ons. And I think that's quite interesting from the earlier stage investors from an exit view, coming into these trade buyers, because there's still a lot of capital out there, and really, really big winner acquisitions that's actually kind of looking for these small businesses.
Yeah, they're also, and I guess quite interestingly for you as investors, a lot of them are looking to fill in capability, whether that's a product capability, whether it's some type of capability for them. And so what they're really looking for is, we want to be a growth business, but in reality, once we get to a certain size, we're not that engine, and therefore, actually, can we acquire things that can bring growth, but also fill in something that we're not able to do ourselves? So they're often looking and saying, coming up with their own grid of technologies we don't have. This is what our client base is asking us for. Where can we find that? And that's typically then starting to look into the types of businesses that you would be investing into, and saying, okay, we need to bring that because it's another product set that we can offer our 10,000, 20,000, 50,000 clients, and that's where that sort of conglomerate effect is happening in that marketplace.
Okay, I've got a question from Bruno, and I'm not sure I fully understand it, but I'll have a go. So do you see global PE funds reducing or outright stopping crossover funding into the VC asset class directly or through FOFs? You can.
So, if I have a go, but Bruno, shout if this is the wrong interpretation of it.
Yeah.
So I think what we see now, actually, so the nature of capital between private equity and VC has been separated a fair amount. So you typically have, because the model's quite different, private equity typically trying to solve for 2, 3, sometimes 4 times return. VC typically significantly greater. And so actually the nature of the capital that's gone into those two parts of the sort of asset management market has been a little bit different. So the market has been one where actually it's been more specialists in the VC market and more specialist investors. Private equity tended to try and stick a bit more to the knitting of, needs to be profitable. We're not necessarily looking to bet the shop on this being the next unicorn. We're happy at a 2-3x return on our money over a 5-year period, versus the VC market of, we want 10 plus times return on it, and we understand that we're playing more of a portfolio game, and that's the difference that you see. So the sort of fund piece is sort of another adage on top, and that's where actually people are saying, look, there's a new way that we can play a capital structure within the VC market or within the private equity market, but it's quite niche, it's quite focused. We haven't yet seen them do a huge amount in the VC market, that they play a big role within the private equity market. But that's probably because it's a bit more mature and the assets are a little bit more mature for fund investors.
So we've had a question from Crisula, and she's asked in terms of specific subsectors. So are you seeing a difference in, I suppose, its valuation shift and appetite from investors, from fintech or consumer tech versus more B2B offerings and things? How have different subsectors been affected?
Yeah, and so it's interesting. So different subsectors are being affected in quite different ways, actually. So if you take fintech, and look, this is a broad brush overview on it, but if you look at some of the sectors like the challenger banks, that's typically been a rush to get people through the door, slightly less focus on the monetization of it. That has significantly shifted in this marketplace. And people are now asking the question of, okay, well, we get that you can sign up, 1,000, 10,000 people onto the platform. Now prove to me that you can really monetize it. Prove that actually your sort of lifetime value of that customer is the sort of numbers that you've been telling me about. And so it's a little bit of prove it out to me. And so actually what we've seen are the valuations across the fintech space has been pretty difficult in the last few months. So fundraising that market has been pretty challenging. It doesn't stop all of the same dynamics though. So as an investor, are all the reasons why you would have invested into the fintechs from 6 months ago, 12 months ago, a couple of years ago the same, which is actually open banking, ease of use, old world banks being quite difficult to sign up to. They need to change their strategies. So none of that's changed. It's just the approach. It's not just a numbers game. We want to see you actually making money from this client base. And I mean, that's a broad brush on fintech. You see it across other sectors as well. It's effectively people saying, look, stop with the kind of vanity numbers. Let's understand what cash is now and how are you going to monetize it. And don't just talk about, ARR growths and revenue growth. Let's actually see that drop through to the bottom line now. So it's a mindset shift, maybe more than individual subsector shift to some extent.
Okay, well, that's really interesting. Had a question from Sheila, and she's asked, as a startup tech entrepreneur, what does this all mean to her? She's looking to fundraise within the next year. What's your advice for her?
Pippa, do you want to have a go?
Yeah, I mean, I think one positive that I think we can definitely draw from the past 6-7 months, that activity has been quite quiet at the beginning of the year. So I think we've noticed that investors are definitely under a bit more pressure to kind of deploy capital and deploy some of their funds. So I think back end of this year and early next year, we'll definitely see that shift to slightly higher activity levels, even though it's been slightly quieter at the beginning of this year. But it again, like depends on product offering, the growth, the profile of the business, and the investors that you're going out to, and just finding actually the right match for your business as well. Rather than kind of going out to 100 different investors, it's actually probably about trying to find that sweet spot and the niche that works best for your business.
And I'd say the other bit that typically happens in sort of, you know, recessionary environments like we're in is actually a flight to quality. So if you're an entrepreneur and you're an investor, and look, we all think our baby's the most beautiful one, right? But investors are really focused on, are you a top quartile business? And then what means if you're going to go and fundraise for your business is, can you prove to an investor that actually you hit this kind of upper quartile KPI? So those are financial things. So, you know, revenue growth, ARR growth, you know, what margins you do, but it's also increasingly sort of what we think of as strategic KPIs. So, you know, your client mix, employee churn, that's really important to a lot of investors. ESG credentials, more and more so, actually. People have funds where they will only deploy if you can tick ESG boxes for them. And so what you often look at is, depending on the nature of the business, who are the right investors for me? And in that flight to quality, how do I prove that I am an upper quartile business? Because actually those are the deals that are getting done in this marketplace.
Okay, thank you. Question from Roz, and she's saying there are a lot of altnets in the UK right now and a lot of similar businesses of higher maturity across Europe. What do you think the UK consolidation of the sector will look like? International or more localized? Also, when do you think it will peak?
It's already peaked, actually. Look, so I think what we see at the moment is actually that that consolidation is continuing at pace, right? So the peak within that kind of end market, you're still seeing people needing to go and acquire. The acquirers are actually more UK out rather than people into the UK market is what we're finding. So UK into Europe rather than probably the other way around for now. And you know, I think we will continue to see more and more consolidation as people try and just build their base within that marketplace. But it's not. It's not a. I'm not sure there's kind of an easy. You know, are you definitely past the peak? Are you seeing loads more consolidation or not in the market? I think you're seeing a general trend that you sort of expect to continue.
I just want to change gear a bit and bring Sandra back into the conversation. So I'm sure it's a thesis, a dissertation, but can you say anything about the potential impact of a shutdown on Russian gas flows to Europe? Is it likely? What's the impact?
That is a thesis indeed. I'll be brief. It's something we're looking at the moment, partly because, of course, we need to construct certain scenarios, and that is certainly one that's not implausible. Also because it is actually financially viable for Russia to do this, given the share that they derive from gas exports is actually not that big relative to that they get from oil exports. And so that makes it possible. The probability we would put on this, very hard to tell. Objectively, maybe a 25% chance or so of this happening. So certainly within the realms of possibility. What would happen? Well, certainly I think in terms of the dynamics I described previously, where the investment that we're seeing in terms of energy infrastructure, etc., in the Eurozone cushioning the economy, well, they would certainly keep on cushioning it, but against a much harder backdrop. And we think in aggregate, this much harder backdrop could put the Eurozone at the heart, if at the epicenter of a recession, if you like. And of course, if you end up with energy rationing in this environment, that would have knock-on effects, not just for companies within Germany, but also those who trade with Germany. And that is, of course, a lot of the Eurozone and a lot of the world as well. So the supply chain disruptions story may, in that case, no longer be confined to China and related areas, but Europe may actually get to the heart of this as well.
And then back to Seb and Pippa, just a couple of wrap-up questions from me. If there are any more from the audience, please let us have them. We've got time for a couple more. What are the exciting tech areas to be thinking about at the moment? What's exciting you? Where would you be putting your money?
I think with me, valuations have come off so much, I'd be tempted to start sort of topping up the portfolio now. I think I added something into my portfolio sort of in January of this year, which couldn't have been worse timing. But I mean, from our space, the investors that we work with, particularly the PE funds, they actually quite like the kind of IT services space. That's kind of more in the IT managed services, IT consulting, and that's just from their perspective as investors, it kind of goes back to the buy and build story. There are lots of synergies to be had when you have these big platform assets. Just, you can strip out so many costs. So if I was from a PE point of view, that's kind of where I'm looking. But I think there are also some like really exciting like new growth technologies coming out as well. And it's just following those trends and finding out where the like key players are. So again, like in the kind of IT managed services, unified comms space, I'm looking at kind of the SD-WAN, these like new technologies, and kind of building up there. But I think Seb probably has also some slightly more the newer technologies that like we look at the RPA space and like DevOps and software engineering and everything. So kind of the more software space Seb looks at, whereas I'm more kind of IT services.
Yeah, and to some extent you can play sort of buzzword bingo with but I think one of the areas that we've spent quite a long time in and actually is maturing in its path around kind of where they go is this idea of hyper automation. So that is, how do you connect your business together and effectively automate it end to end? So using things like robotics, bringing AI into your business, using natural language, so interpretation of what your customers are saying to you in either written text or verbally, and actually how do you then stitch that all together so that you can automate the whole process for your client base? And we see that from everybody from big banks, insurance companies, all the way through to the SME market. People are trying to automate because actually that's a big area of margin improvement for them. So so that anywhere along that sort of stack is exciting. As I say, you sort of 3-letter acronyms, you can throw them out, and they're probably exciting areas to be investing in right now.
Okay, and is it a good time to be an investor right now?
I think it's a good time to be putting your money in now. I'm not sure if you did it 6 months ago, you'd be quite as happy. Yeah, look, and for me, it comes back to, if you think about technology businesses, that is today's infrastructure. And so for me, now is a pretty good time to be investing, and particularly into the disrupted areas of the marketplace, because in reality, everything that you're seeing from that sort of macro environment, as an investor, you're thinking 3, 5, 10 years in advance, and actually you should be less worried about the sort of the here and now from a market cycle, but actually where do you think people will be buying technology into the future, and therefore if I'm disrupting those markets, that's a pretty nice place to be, as long as you take the longer term view and you sort of ride out to some extent the highs and the lows. If you're an investor, put your money in 6 months ago, it's probably a tough place right now. But actually, if you think those are long-term infrastructure type investments, you should be able to get yourself comfortable with that. And I think it's tech businesses remain a pretty interesting place to be investing at the moment.
That's great, and fantastic to end on a positive. I think we will end it there. Thank you all very much for your amazing presentations and the discussion. Thank you, everybody, for your thoughtful questions. We have just got one more slide with some links for people if they want to find out more about Angel Academy. If you want more information about Investec, Hannah Goody is our main contact there, and her email address is on the last slide. We're always interested in speaking to new angel investors who want to join us. So have a look at our website. There's a short form, fill in. We're reviewing constantly applications to pitch from founders. So don't think that we've stopped working just because it's the summer. We won't be having pitch events until September, but we are reviewing applications. So again, please apply via our website. Do follow us on LinkedIn, newsletter, subscribe to our newsletter, and a recording of this event will appear on our YouTube channel in due course. And we've got loads of other Investor Academy sessions there covering all sorts of sector analysis, but as well different aspects of angel investment. Well, thank you all very much for joining us. Enjoy a lovely sunny evening. I'm off for a swim now in the sea, so speak to you all soon. Thanks very much.